In 1966, the market was a mystery, a puzzle with no solution. Fortunes were made and lost on hunches, on whispers, on a trader's gut. And in Princeton, New Jersey, a brilliant mathematician named Jim Simons believed he could crack it. He wasn't a trader. He was a geometer, a man who studied the shapes of space itself. But Simons had an idea. What if the market wasn't chaos? What if it was pattern? What if you could teach a machine to see what human eyes couldn't? At the Institute for Defense Analysis, working in the shadows of the Cold War, Simons and his colleagues built something called iStar, an automated trading system, one of the first. They fed it data. They ran the algorithms. And quietly, behind closed doors, they tried to prove that trading could be reduced to mathematics. But the Institute wasn't a brokerage. It was a defense think tank. And when management found out what Simons was doing, when they realized their mathematician was running an unauthorized trading operation, they shut it down. The experiment failed. Simons was forced out. By 1968, he was gone. To the world, Jim Simons was a footnote, a brilliant mathematician who'd gotten distracted by something as pedestrian as making money. And then he'd failed. Case closed. For the next 10 years, Simons disappeared from Wall Street's memory. He took a job teaching mathematics at SUNY Stony Brook. And there, in the quiet of academic life, he did something Wall Street had no idea he was doing. He kept thinking about the problem. In 1974, he won the Oswald Veblen Prize, one of mathematics' highest honors, for his work in differential geometry. He was world-class, legitimately brilliant, the kind of mathematician other mathematicians feared. But the street had moved on. Simons the trader was dead. Dead ideas don't resurrect themselves. That's the rule in finance. You fail, you're done. Your edge dulls. Your credibility is gone. Time moves forward. Except Simons wasn't thinking about edges or credibility. He was thinking about something deeper. He was thinking about why iStar had failed. And slowly, over a decade of teaching and research, the answer crystallized. The answer was you. In 1978, Simons made a move that nobody in finance understood. He left academia. He founded Monometrics, which would later become Renaissance Technologies. And he didn't go looking for traders. He hired mathematicians. Specifically, he brought in Leonard E. Baum and James Axe, computational mathematicians. Neither of them had ever worked on Wall Street. Neither of them had ever placed a trade. Neither of them had the intuition, the feel, the sixth sense that traders spent years developing. This was the radical move. This was the inversion. Because Simons had figured out what everyone else was too invested in the old story to understand. Trading wasn't an art. It was a computational problem. The old narrative said the best traders were the sharpest, the most intuitive, the ones who felt the market's pulse, the ones who could sense what was coming. But Simons had spent 10 years thinking about this, and he realized that story was a comforting lie. The real edge, the edge that actually works, isn't predicting what the market will do. It's detecting statistical anomalies that humans can't see. It's finding the recurring patterns in noise, the micro-inefficiencies that exist for microseconds before the market corrects itself. You don't need intuition for that. You need mathematics. You need data. You need a machine that can see faster than any human brain ever could. And you need to be willing to admit something that no trader wants to admit. You're not going to solve this problem. A machine is. By 1988, Simons had spent a decade building his system. He'd collected mountains of historical data. He'd written algorithms that looked for patterns in commodity prices, interest rates, currency fluctuations, patterns that moved like clockwork, patterns that nobody else could see because they were too small, too fast, too subtle. In 1988, he launched the Medallion Fund. The returns were catastrophic in the way that breaks the entire game. From 1988 to 2018, Medallion averaged 66.1% annual returns. Not 6%, not 16%, 66%. After fees, every single year, through bull markets and crashes and the complete reordering of global finance. This wasn't luck. Luck doesn't compound for 30 years. This wasn't genius. Genius falters. This was a machine, trained on decades of market data, optimized to exploit inefficiencies that humans couldn't perceive, making thousands of tiny trades, capturing pennies, without emotion, without ego, without discretion, and the most important part, without Jim Simons. The Medallion Fund's success wasn't Simons's intuition. It wasn't his feel for the market. It was his permission structure. His ability to build a system where the human trader, the intuition, the ego, the hope, was completely removed from the decision. He had solved the puzzle by admitting that the puzzle couldn't be solved by humans. Not because humans aren't smart enough, but because the market's inefficiencies are too small and too fast for the human nervous system. You understand what's happened here if you understand what came before. Livermore lost everything and came back, but he came back as a better trader. He refined his edge. He learned to control his psychology. He was still the detective. He was just a smarter one. Soros lost everything and came back. But he came back with philosophy, with a theory of reflexivity, with a deeper understanding of how markets actually move. He was still the thinker. He was just more thoughtful. Simons did something different. He lost, he disappeared, and when he came back, he stopped being a trader. He became a systems architect, a permission structure builder, a man who realized that the path to winning wasn't to get better at the game. It was to stop playing the game. This is the hardest insight in trading, the one that costs the most to admit. The future of trading isn't smarter traders. It's traders smart enough to remove themselves from the equation. Because human intuition is a bug, not in one trader or another, in all traders, in all humans. We see patterns that aren't there. We double down on winning streaks. We second-guess winning algorithms because they don't feel right. We are, by design, unreliable arbiters of probability. Simons didn't come back from failure to trade better. He came back to invent something entirely new. A market without traders in it. By 2010, Simons stepped back from day-to-day trading. By then, Medallion had generated over $100 billion in returns, not just for him, for the small group of mathematicians and researchers who understood what he'd figured out. He became a philanthropist, a founder of the Simons Foundation, a man who'd spent tens of billions on research, on education, on the kind of questions that matter. But the real monument isn't the money. It's the realization. Simons didn't resurrect himself as a trader. He resurrected himself as someone who proved that trading as we understood it, as an art, a skill, a human endeavor, was over. The market had always been a puzzle, an unsolvable riddle. For 100 years, traders had been trying to solve it through intuition, through study, through will, and some had made fortunes. But the real winner, the one who actually cracked the code, was the man who stopped trying to solve it like a human. He admitted the problem. He removed himself from the solution, and in doing so, he didn't just win, he changed what winning means. Total runtime: 8:45 at 1:42 WPM. Word count: 1,278 words. Keyframes requested: 17 C bracketed sections for placement. Maintain measured, authoritative pace throughout. Emphasize the conceptual shifts as inevitable realizations, not breakthroughs. The tone should feel like someone uncovering a hard truth, not celebrating a victory. Imagery should contrast: human traders, emotional, uncertain, versus algorithms, calm, certain. The closing should feel like recognition, not triumph.